Reno and I will be talking to you about the fundamentals of the investment market. Reno is a partner of Cushman Wakefield, responsible for capital markets business space in Spain. We intend to cover briefly the fundamentals of the market, some of the profile of the investors, some of the historic volumes, rents and yields, and then more looking forward to trends and what we see as the main opportunities in each market. But if we look at the fundamentals first, they are indeed very compelling. If you look at, for instance, GDP growth, which is obviously a very obvious indicator, you see that in the 2011 to 2014 crisis years, and particularly Portugal, suffered majorly, but the comeback has been astonishing, and that goes for both countries, even more so for Spain, with growth rates of in excess of 3%. Portugal slightly less so, although the most recent figures for Portugal are quite spectacular. The Institute of Statistics released Q1 figures yesterday, and in Portugal we had annualized growth of 2.8%. Other indicators like unemployment, which of course traditionally been very high in Spain, was coming back from the height of 25% to now about 18%. In Portugal, which had traditionally a much lower rate, that went up quite exponentially in the financial assistance years to 18%, now back to just under 10%. So all of that creates a lot of confidence in the market, both from the consumer side and from the business side. And that, of course, comes through in consumer demand, in the office occupiers markets, etc. The other driver, which is very important for both countries, is tourism. Of course, as a result of or partly as a result of the events in the Mediterranean basin, tourism has focused very much on safer southern European countries. Portugal benefited massively. I mean, all our indicators are up by double-digit, number of visitors, number of bed nights, RevPAR as well, which is important. So the income is increasing. So tourism a very major factor in growth, and again that also, of course, feeds into retail and food and beverage, etc. In terms of the property markets, as I said, the occupier market is very strong, both on the office and the retail side. We'll come back to that, and also the amount of capital still very much there.
Thank you, Eric. Thank you. Very good to hear about the positive indicators. Let's talk a bit now about investment. Now, what we have here is the famous Cushman Wakefield capital flows graph. Now, we chose this, speaking to Eric, because it really mirrors what we're seeing in Iberia at the moment, which is quite important at the end of the day. Last year, all aware, total investment volume for Europe was about 280 billion. Slight drop, I think 16% on the previous year. Something very similar that we saw in the case of Spain. To a certain extent, this is one of the case of Portugal. But what's very interesting here is that if we actually look at where the capital is actually coming from, we've got the blue, the gross capital coming out, net, in this case, position as well, in the greyish white. American, essentially North American money, fallen by about 45%. We've seen a very similar position in Spain. Moving through the cycle, more core, value add, core plus money coming in. European money, very important, dominant in the Spanish market, important percentage in Portugal as well, but playing a very important role in terms of what's going on. Asia Pacific, really focused in terms of Europe on the 3-4 gateway cities. We haven't seen that much in southern Europe as yet. We are starting to see a lot of interest coming through, particularly from Chinese money, looking at specific developments in both Madrid, Barcelona, and the south of Spain. So we're seeing the capital come in. What has been the impact in terms of overall investment volumes? We can see here, left-hand side Spain, right-hand side Portugal, exponential growth in investment volumes. We've seen a 350% increase in Spain in investment volumes between 2013 and 2016. Importantly, in terms of the European context, Iberia, as a percentage, has increased from just over 1% to over 5.5% now of the total investment volume in terms of European real estate. In Spain, we're seeing some negative evolution. I think essentially it's down to some of the corporate deals, one-off deals that we're unlikely to see in the future moving forward. So we're getting down now to what we believe will be a stable level of investment. If you look at the average across the last 10 years, we've had about 9 billion euros invested in Spain over that period of time. Portugal, I think, is somewhat different in terms of its position in the cycle. Already in 2015, Portugal exceeded the investment volumes for compared to the last cycle. Slight reduction last year, but what really surprises me now, in a positive manner, is the anticipated volume for this year. 3 billion, if I recall, Eric.
Yeah, I must confess, we're sticking our neck out a little bit here, but there is a lot of transactional activity going on at the moment. So we reckon that if 75% of all those intents actually come through, we should have volumes in excess of 2 billion.
Well, I made a bet with Eric last night. He's actually done 300 million so far. So I said, Eric, you've got a long way to go, but if you get there, I'll buy you lunch at the end of the day. So we've got the capital coming in. We're seeing the investment volumes increase, albeit with certain adjustments. But what's the strategy of investors? Now, I remember speaking to people here this morning. They were saying, Reno, we've always perceived Spain as being a distressed destination, which is true until a couple of years ago. You look where the market is now. As we've evolved, essentially, we're now perceived in terms of investment strategy. Look here at the graph on the left-hand side as a value add and core plus play at the end of the day. You look at the opportunistic capital coming in, essentially focused on the residential market. We're not seeing that much in terms of the commercial market. And the core money, it's there. The problem is the product. We struggle to find core product, both in terms of liquidity, but importantly in terms of the quality of the product at the end of the day. What I found very interesting is the asset class. Where are investors investing? And we've got here about just over 60% in the traditional classic real estate, the offices, the shopping centres, the industrial. But we've seen a massive increase in what we term as other. Let me just explain what is other. Other in the day is hotels. We're seeing residential, but residential buy to lease on the back of potential capital appreciation. Student housing, you look at the potential in terms of the market for student housing. Nursing homes, so these alternative investments taking a far, far more important role as they have in the previous years. And again, as I said before, looking at where the money is coming from, domestic, I'm not too sure if this is completely right because we're actually including here the SOTHIMIs. Are they domestic? Are they international in terms of management versus capital? But again, important percentage of European. The USA money here is essentially on the residential side, that we're seeing, not so much in terms of the commercial. But that's where we are in terms of the investor strategy profile.
Yeah, Portugal is slightly different in the sense that, particularly in the last 15 or 18 months, the actual transactional activity has been mainly in the core space, and that's been really as a result of the product that was available. Large business, large office parks, retail sale and leasebacks, supermarket sale and leasebacks, some shopping centres. So that explains why on the left-hand side, the majority of the type of investment is still in the core and core plus field. In terms of assets, it's mainly offices, and again, that's as I said, very much a result of a couple of large transactions. Retail, and then less so in others, although the others here include some large hotels transactions as well. The origin of money is very different from Spain. I mean, and this is the big difference also with the previous cycle. I mean, until 2007, the Portuguese market was very much dominated by the Portuguese property funds and the German property funds. Relatively, I wouldn't say boring, but let's say conservative investments, long term, all sort of looking at more or less the same things, competing for the same type of product, and not a lot of liquidity in the market. That has completely changed. I mean, we are now seeing investors from all over the world. Literally, that goes from South America to Asia. We see a lot of American, a lot of US money. Blackstone, of course, being very predominant here, and we'll have Paolo here later in the panel to maybe talk a little bit about that. And very little domestic. And even the domestic we see in Portugal generally has foreign capital behind it. So that's in terms of the profiles, or the current profile of the investors in both markets. If we just look at rents and yields and where they've come from, this is the 10-year prime rents in offices to the left, shopping centres and high streets to the right. The light blue line is Spanish prime yields, and the dark blue is Portuguese. And you see again very different profiles. Whereas the Portuguese office market has been relatively stable throughout the crisis. Again, relatively boring if you want, more or less, with 10% variation. The Spanish markets, the Spanish are generally more fiery and more enthusiastic about things, highs and lows. So the variation there has been much higher. But what's interesting to note in the case of Spain, for example, is there's still about a 30% differential between where the prime rents were in the previous peak to where they are today. Shopping centres is the only area where Portuguese rents are actually higher, prime rents are higher than in Spain. That's explained by, I would say, generally the success of the Portuguese shopping centres, very long opening hours, and also it's where the Portuguese consumer spends the most of his disposable income as a result of a relatively incipient high street scene yet, although that is changing. And then in high street retail, again, there's not a lot of variation between the prime rents over the last 10 years. What is striking here, of course, is the difference between prime rents in Portugal and in Spain. So again, explained by a very vibrant high street scene in Madrid, Barcelona, and other Spanish cities, and less so in Portugal. You would therefore hope that Portugal has some catching up to do. In terms of yields, again, dark blue is Portugal, light blue is Spain. Of course, Portuguese yields, there's always an arbitrage of 75 to 100 basis points between Portuguese and Spanish yields. Spanish markets are obviously much more liquid and larger. But what you see, of course, is that yields have more or less come full cycle. Previous peak to current, more or less at the same level. Generally, actually slightly lower, and some very keen yields now being seen. Portuguese prime yields still around the 5%, generally speaking. Spanish, of course, 4 or below.
So what's been the impact of this capital? Has it been successful in terms of its returns? Here we have, and we've been looking carefully at this over the past 12 months or so, total returns from Spanish real estate. I think the best way to look at it in terms of comparing markets, comparing asset classes, to look at the overall total returns. So we're looking at both the income yield together with rental growth, capital appreciation coming through in terms of yield compression, CPI in the case of Spain and Portugal as well, very important. And if we look overall on the right-hand side, we've seen that Spain as a country in terms of total returns, together with Portugal, number 2 and number 4 respectively. To give you an idea, we're actually looking at the office market in Madrid for the last 12 months, and the total returns in Madrid were about 17% for offices last year. Important to recognise, and I think I spoke to Michael about this earlier whilst we had breakfast, the majority, in the case of Spain, and to a major extent I think Portugal as well, the majority of these total returns have come from yield compression. We've seen a certain amount of rental growth for the best buildings, but we're still waiting for that rental growth to really come through. And that's really the play, as Eric said quite rightly earlier, we're seen as a value add play because of that potential moving forward. Now, if you look at the market overall, you look at the last 3 years, you see that both markets have performed, but I think it's important to recognise that we believe the total returns will fall. Last year we were talking about 13%, this year we're talking about 8 to 10% overall, is where we believe the overall numbers will come out across the board. As the market evolves, becomes more mature, and obviously the capital coming in differs from what we saw a couple of years ago. You can say, well, Reno, are we going to see any different trends at the end of the day? Will we see changes? I think the pipeline is still strong. I think it's important to recognise that not everything's on the market in Spain, but a lot could be bought. So again, off-market transactions. But importantly, the theme is now reaching their 3-year period. We're going to start to see recycling of assets. We're seeing it already at the end of the day in terms of buildings coming on the market that were bought back in 2014. Again, indirect and JVs. We've been very, very active on the JV side, teaming up international capital with local knowledge, particularly in the student housing sector. We believe there's an important play, but again, we've got to produce the product. The product doesn't exist at the moment. Banks. The banks still have an issue in Spain. You look at the latest report from Evercore in terms of REOs, NPLs, there's still an issue there. We're seeing more coming through. What I tend to see is that there's more perhaps smaller portfolios, single asset deals, as well as the NPL work, so that's quite positive. And again, as I mentioned before, alternative investments. Now, I think I'd be wrong to say that things are going to continue that way forever. I think we will see changes. And what we've been looking at, and forgive this graph, this is very busy, but what we've been trying to do is to look at the spreads between prime property yields and Spanish 10-year bonds and think, where could this go moving forward? So to give you some facts, I've got the numbers in my head for Spain offices. During the last cycle, 2000-2007, the spread between the 10-year gilt bonds and the prime property yield for offices in Madrid and Barcelona was about 75 points. Last 3 years, that's increased to 220. We're seeing changes. We think there's margin there that we're going to see limited impact in the short term. But then you look at the latest research, it's not great to look at here, from Oxford Economics. And we're seeing that clearly with tapering, with the posture that's been taken by Mr. Draghi, we will see changes. We're anticipating that Spanish bonds and Portuguese bonds will move out, in theory, 2020, 2021, and that will have an impact in terms of property yields overall. The amount, it's difficult to say, it depends on rental growth at the end of the day. We're still waiting for that to come through. But we are anticipating movements. It depends on the asset class, the sector. We're talking between 40 and 80 points overall. So there will be changes moving forward, but the exact amount of those changes is difficult to establish today. So what about the opportunities moving forward? I mentioned before, just focusing on prime, I think we've seen overall it's very difficult. So we're looking, particularly in the retail market, the high street market, I'm sure Paolo will tell me later if we're right or wrong, near prime locations. Areas around the Gran Via in Madrid, not prime for the time being, but will, we believe, become prime, given the fact we're talking about very dense cities. Development's back, but it's very difficult to fund. Very difficult. Look at what the banks have on their books. Funding development today, land acquisition is particularly difficult. So what we're doing is forward funding, forward purchase, assuming more commercial risk, to a certain extent development risk, but getting in there with margins in terms of leased accommodation. Retail high streets, we believe, in the top 10 cities, not just Madrid and Barcelona. Again, we think there's a certain amount of play there. Or secondary towns, but the dominant schemes in those particular secondary towns. Offices in Madrid and Barcelona, not an easy one. We've been talking this for quite some time. Conversion, refurbishment. It's not straightforward. Difficult in Barca, given the change of use to residential, but definitely potential. And as I said before, student housing, other alternative sectors, including healthcare, would be an example.
Yeah, and in Portugal, I think the theme is similar. Where we see opportunities in Portugal is very much focusing very much on the occupier side, which so where there's a strong underlying occupational fundamentals. There's a shortage of local capital, that remains the case. So that means there's opportunities for overseas capital, for joint ventures, for takeovers, M&A activity. We're experiencing a lack of offices in both Lisbon and Porto. Lisbon, of course, the much major market in the country. There's a lot of demand coming from the business process outsourcing units, shared service centers, etc., who are locating centers into Portugal, which is really one of the key selling points at the moment of the country. But that creates a lack of office space. There's a lot of demand which is difficult to satisfy. The vacancy rate in offices at the moment is about 8%, but it's very scattered around, and the quality is of varying quality. So clearly an opportunity for office development in both Lisbon and Porto. Retail always been popular in Portugal. Our shopping centres are world renowned, very popular also amongst international investors, and they still are performing very well. But also neighbourhood and convenience centres. We see opportunities for smaller retail schemes, more focused on convenience, etc., which we believe is a trend generally for people to the consumer maybe to not want to drive 20 minutes and spend 3 hours in a shopping centre, but do more quicker shopping trips. NPLs, which is becoming a theme, and there have been NPL sales in the past, but it's clearly coming back now. Caixa, which is the big state-owned bank, have called in a number of agents, including us, to start talking about this, and so we will see some major portfolios on the market, we believe. And again, also in Portugal, the alternatives. We see not a lot yet. We see a lot of interest in student housing, for example, although not a lot of actual transactions yet. We see much more interest in hotels. We're starting to see interest in healthcare and other sectors, parking, and of course tourism, which is, as I said before, one of the big drivers of the economy. So, in summary, we believe there is a very positive investment climate in both countries, with strong economic fundamentals, with political stability. We see strong occupier markets generally in all sectors. They are, both countries are probably in different parts of the cycle. Spain, of course, more advanced, more mature, probably 12 to 18 months ahead. In Spain, you're probably going to see more of a rental growth play. In Portugal, there's probably still more of a yield compression play, but in both countries, we believe that there's value to be created. We reckon you need to be creative and agile and manage your risk appropriately. But if you do all that, then we're sure you'll be successful. And our 250 colleagues in Spain and 90 colleagues in Portugal will be very, very pleased to assist you. Thank you.
Thank you. Thanks so much.